Hello, and welcome to the webinar titled Business Valuation, Key for Your Client's Business and the Financial Professional. I'm Shannon Griffin of NAIFA. Our program today is brought to you by the sponsors of NAIFA's Investment, Retirement, Estate, and Advanced Planning Center. iREP delivers invaluable support to insurance agents and financial advisors by providing access to timely, expert-led resources in areas such as retirement, wealth, legacy, and advanced planning. Thank you to our sponsors, and please visit the website to learn more about iREP and NAIFA's other knowledge centers. We'll put the website address in the chat. Now, just a couple of quick housekeeping items before we get into the presentation. First, this webinar is being recorded, and all registrants will be emailed a link to the recording in about a week or so. The recording will also be posted on the NAIFA website. Regarding CE credit, for today's live webinar, the credits available are one CFP credit, one professional recertification credit, and one CPE credit for accountants. There are no state insurance credits. If you requested credits when you registered, a certificate of completion will be emailed to you in a week or two, assuming you successfully complete the webinar. Also, for accounting credit, be sure to make a note of the 3 CPE participation codes that will be verbally announced during the webinar. After the program, you will need to enter those 3 codes on the evaluation in order to be awarded CPE credit. Those codes are only needed for accounting credit, not CFP or professional recertification. If you have any questions at all about CE credits, just send a message through the Q&A or chat feature, and I can respond to you directly. And submit any questions you have for the presenters in the Q&A or chat feature as well. We may take some questions throughout the webinar, and we will have some time at the end. Now, let me briefly introduce our 2 panelists. Andrew Wren is the Assistant Vice President of Advanced Strategies at Sammons Financial Group. His expertise includes wealth preservation, estate planning, business planning, and executive benefits. Stephen Sussel is a Managing Director of MS Capital, a subsidiary of Marshall and Stevens Incorporated. He is responsible for business development, relationship management, and transaction execution. Thank you both for being with us today. And Andrew, I will turn it over to you.
All right, Shannon, thank you very much, and welcome to everyone that's viewing here today or maybe listening separately. Also want to give another special thanks to NAIFA for putting on this iREP webinar here today. We have a very fascinating topic to discuss, and one that impacts both clients, but also financial professionals, agents themselves. And, we're going to be talking about business valuation, and we're going to be hitting a little bit later the impact of business valuation on FinPros, agents, advisors, own practice. And that'll be a great part of our conversation, so stay tuned. That's going to be coming up. Now, Steve, you and I put a lot of time into thinking about how we were going to present here today. We tossed around the idea of doing a traditional slide deck. We decided to go ahead and not do that. We're going to go ahead and have a conversation, if you will. So really, it's going to be a back and forth on any and all things related to business valuation. So let's start that conversation, if you will, Steve. So let's just kick things off. So share a few things for those tuning in here today, a few things they need to know about Marshall and Stevens, the firm that you represent.
Sure, Andrew, and thanks. We really appreciate being able to participate here. Marshall and Stevens is a national valuation firm. We do valuation work for everybody from Fortune 100 to local and regional businesses for government reporting, transactions, litigation, planning, whatever you need a formal or informal opinion of value for. We have people on staff that can address those issues. We cover all the different valuation needs that a company may have in their life cycle. Marshall and Stevens has been around for a little over 90 years. We have 14 offices around the country, about 200 valuation professionals. We truly are nationwide. We've worked in all the different industries out there, and again, have done companies from Maine to Hawaii, from Alaska to Florida. So literally, we've seen everything and been every place in our history.
No, absolutely. Yeah, as you've mentioned, you guys have been around for a long period of time. And, I'm thinking about, let's just get right into it. I mean, when we're talking about business valuation, you hear a lot of phrases thrown out there, valuations, appraisals, formal versus informal, calculations of value. Can you help clear up some of the terminology a little bit here for those listening and viewing here today? What does some of those things mean?
The great question. And the answer is that there are a lot of different valuations out there. There are a lot of different types of valuations, and there are a lot of different valuations that are used for specific purposes in a company's needs, whether it's, again, litigation or transaction or reporting. There are various things that have to be valued. In general, a traditional valuation is the valuation of an overall business, the whole business entity. And that could be a full formal fair market value valuation is really kind of the basic valuation that takes place. And what that is that it's a complete review of all the financials and using multiple different methodologies, arriving at a down to the penny value for the business on a fair market value basis. And fair market value is kind of the middle of the road defendable value standard, and really the valuation methodology the IRS counts on for a lot of things, as well as the Department of Labor, as well as a lot of the buy-sells out there are all based on fair market value. An overall valuation, a full valuation, is a down to the penny report that's defendable and submissible for a variety of needs. There are also different types of products. There's a calculation of value. A calculation of value is an informal valuation. It's based on the process that goes into a full formal valuation, but it's an abbreviated process. We only use a few years of financials, and we have to get some basic data and come up with a range of value versus that down to the penny value. And that range, that calculation of value is really great for beginning the process, beginning the conversation process. What is the valuation of the business? What are the planning needs of a client? Is the buy-sell funded appropriately? I may transition to a family member or next generation or employee, whatever. What's the overall value of the business? It's a basic valuation that's kind of a starter valuation. And it's just, you don't have to go through the whole process, but you get a pretty good idea what value is.
Right. I think that helps. And one thing I wanted to make extra sure of, if there's questions, thoughts, put them into chat. We're going to have about 15 minutes reserved at the very end for you to ask any and all questions while we have Steve here with us here today. See if you could stump him, all right? But throw in the questions. And as we talk here today, if we haven't covered a point, I'm sure that you could throw it in a chat, and we can cover it before we're done here today. So let's keep going. What's an interaction with Marshall and Stevens look like? Because I have a feeling by the time we're done here, Steve, everybody's going to want to know more about Marshall and Stevens. They're going to want to know more about getting a calculation of value, a valuation, or even an appraisal. Let's take a step back. What is that interaction, that connection with Marshall and Stevens? What does that look like, and how does it happen?
Well, it really starts out with a need. What is the need that the client has? What is the need that the company has? Is it a formal valuation? And that formal valuation might be for gift and estate purposes. Maybe somebody's doing some gifting and needs reporting for IRS purposes. Maybe there's an estate issue or estate valuation. There's an asset, a business that needs to be valued, again, for IRS purposes. Maybe there's a divorce, and there's a question of value for a large business asset. There's a valuation that's needed there. There are a variety of reasons, and it really comes with that need. The other need is from a planning perspective. What is the plan? What is the value of my client's largest asset? I'm planning for their future. I'm helping them figure out what they're going to do. I'm figuring out if there are any estate issues. In order to create an estate plan, you have to understand what the value of your largest asset is. And a calculation of value is perfect for getting that process started. So really it depends on the need for that. Once that happens, once there is that need and there's contacting us, it goes a couple of different ways. For a full formal valuation, we try to we set them up with one of our senior appraisers who has a clear idea of what the engagement is. And then there's document requests. We go back and forth. We do a lot of modeling. There's interaction between us and the client to try to make sure we have the best information possible, because that's critical. information is the key to having an accurate, well-developed valuation. And by doing that, we can get the best results. And then we go through the process, and at the end of the day, it comes down to the penny value for the valuation product, which is then issued. Then a report is issued for that, and that's a written report that could be 20, 40, 60 pages long, depending on the valuation need. From a calculation of value perspective, we don't need quite as much information, whether it's through you or the advisor or the client. We get 3 years of financials, balance sheet and income statement. We don't like tax returns. Tax returns has the ultimate objective of the number zero, but we use formal financials, and we have a simple questionnaire. And with that, after within about 10 days to 10 to 15 business days, we can develop a calculation of value, a range of value that is then deliverable to the advisor and the client, and then we discuss it with them. And we discuss what it means, what the results look like, and if there are any questions about what the next steps forward are, we're happy to interact with them in that sense too.
You just reminded me of something. So just kind of like an ad hoc question for you. You talked about not using tax returns because the goal of a tax return is zero, and that might not be the best way to value a business. But aren't there a lot of, without naming names, valuation tools out there that do rely on tax returns, that approach valuation in an entirely different way? What do they know that we don't? Any thoughts or opinions on that?
There are a bunch of different ways there's a bunch of different software packages and other things that do a great job, and they do a good overview, provide a good overview of valuation. The key from a valuation perspective is the quality of the information that you're providing the appraiser and you're putting into any process. The more detailed, the more exact the information is, the better the results are, the more accurate the results are. The challenge with a tax return is that you're looking to pay a limit, there's no taxes. And so, the data is in a bunch of different spots. It's tough for us to identify. We have to go fishing, in all honesty. We don't want the personal information either. And, it's tough for us to find the best data or the most accurate data we can in a balance sheet, in an income statement, accounting notes, or whatever it is that we can get, a formal financial statements. The data is laid out, it's clean, it's well placed, and it allows us to ask questions because it also shows how everything interacts. And that's the important part.
Right. That's good. What about a new business that might not have 3 years worth of financials? Maybe they have a year. Maybe it's a startup. How do you guys deal with those situations?
Valuations can be done. However, you have to caveat it and say, look, this is a startup. This is challenging. A key component of any valuation are the projections, and looking out in the future and being able to project out what the performance is. Using one of the methodologies, you have to be able to project out 5 years, but really being able to look at those projections, defend any assumptions that go into the projections, and really be able to show that they're accurate and realistic. To come off, is evaluation possible for a startup company? Absolutely, it's possible. However, you also have to acknowledge it is a startup, and there are additional startup expenses in that first or second or even third year that may affect overall performance. There may be other revenue issues or other challenges. There may be a delay in the implementation of the business. There are a variety of things. You just have to be able to caveat it and point out that, yes, it is a startup. We're working with 1 or 18 months, 12 or 18 months worth of financials. There's not a long financial history here that we can rely on to show performance.
Well, that makes perfect sense. Well, Steve, I get the honor of announcing the first CPE participation code. So let me go ahead and do that real quick. Then we'll return to our discussion, our conversation. So CPE participation code number 1. So this is participation code number 1 for CPE. That code, it's actually a word. It's valuation. That's valuation. 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 Okay, wonderful. Okay, and we're going to be returning to advisors and their practices and the whole idea of valuation just in a little bit. But I guess I think about it this way. You think of advisors that have clients, then advisors themselves. Those are two different lenses, if you will, when it comes to valuing a business or a practice. Let's talk about those lenses. How do they differ, if at all, between an advisor and a client in your experience? Because I'm sure you've dealt with hundreds, if not thousands, of both.
Yeah, absolutely. And fundamentally, you're doing it for the same reason. Fundamentally, when you're doing a calculation of value or beginning the process, you're doing a valuation because you have in many cases, a planning need or a transaction need, or you need an overview of value for whatever purpose it is. So fundamentally, you're doing it for the same reasons. The methodology can be different. Every industry has their own little quirks, and there are very few industries we haven't done valuation in. And so you look at what different valuation drivers are for different industries, and you bring them into the different methodologies, whether that's looking at comparable companies or discounted cash flow, or in some cases an asset approach, or maybe they're public companies that are comparable that you can use. There are four general methodologies that go into the valuation process. But for an advisor, from an advisor's perspective, it's become a little more detailed, and people will look at potential buyers, potential valuers, will look at a breakdown of their business lines. They may look at it from this is a life insurance, this may be a term, this might be an asset management, this might be an annuity. There are a variety of ways to look at it, to break out revenue, and there are different multiples that may be assigned to each type of revenue. Same thing can happen for a client company. Just depends on the industry, and all industries are a little bit different. Farms, we do a lot of agriculture work. Farms are different than manufacturing companies, which may be different than a tech company, which may be different than a construction company. It all kind of depends on the industry group, and we spend a lot of time making sure we have the best data for that industry group. And just one note, when you deal with a company that has a lot of assets, that asset approach gets important, because sometimes the asset value is worth more than the financial value of the business. So that comes into play. There are a lot of different ways to value a business, but again, fundamentally, advisors and their clients are valuing their companies or their practices for the same reason.
Got you. Well, we have some questions coming up in chat. We're going to hold those off until the very end, but you got some good ones coming up, Steve. So again, to the audience here today, make sure to get your questions into the Q&A sooner rather than later. I got an ad hoc question on my phone for somebody that knows me. I think this is appropriate. Hopefully NAIFA won't come down on me here, but they're asking, Marshall, okay, you mentioned you do business valuations for almost every company. What don't you do valuations? What kind of companies do you not do valuations for?
I mean, we literally have valued everything from, again, your run-of-the-mill lawn care and machinery companies down the street, to Major League sports stadiums, to casinos in Las Vegas, to orchards in California. Our Dallas office does a lot of mineral rights and oil, gas, and grasslands. We've done a lot of it. I would say that some of the banking, if you're asking us to value a bank, we probably would not value a bank. A direct financial service entity. Practices are one thing, insurance practices and stuff like that are one thing. But if you're asking us to value a bank, that's different. Do we do work for banks? Yes. Will we value the bank itself? Probably not. There are a variety of different reasons to value other assets. It all depends. But I would say that the banking sector is probably one area where we would defer, or we'd refer you to another group.
That's fair. Another question, you keep talking about documentation and how we like to steer clear of tax returns. I think everybody listening today understands why. What other sort of documentation do you require to get a proper either calculation of value or an appraisal? Is there anything we're missing here?
So let's start with the calculation value, because that's the abbreviated model and that's not the formal valuation. For calculation value, we like to get 3 years of financials, balance sheet and income statement. If there's accounting notes, they're always appreciated because that gives context to the business itself. And that type of data and broken out will allow us to do some analysis and to understand the trends and the financials and the earnings and revenue streams and everything. That's good style to start. We also have a questionnaire that's pretty basic that we ask people to fill out. It's not that challenging. Really, the biggest and most important question on our page on our questionnaire relates to earnings before interest, taxes, depreciation, amortization, EBITDA, because EBITDA is a key component of any valuation. And it's important to understand what adjusted EBITDA is. And adjusted EBITDA basically goes back and kind of adds back those one-time expenses, what's being run through the business, any capital expenditures, because that's a legitimate add back. And that really does help drive value or changes value, I should say, because the more adjustments there are, the more accurate the actual reporting is. So from a calculation of value, the documentation needs is relatively limited. On the other hand, a full formal valuation, we have a whole document request list that we send out in conjunction with our work for that. Our senior appraisers have lists of documents, and they could be obviously the basic financials are there, but it could be breakdowns of clients, because you have client concentration questions. What are the trends in the business? Will help somebody create projections or give them a sort of a template to help generate projections, because projections, as I said before, is a really key component of any valuation. Any transaction you need, it's important to understand what the steps are moving into the future. We may look for an asset list if it's a company that has a lot of assets. If there's a lot of real estate, we may look for property and land details. The due diligence request list is a pretty comprehensive list, and in some cases it may not apply, but we ask for a lot because, again, it all goes back. Marshall & Stevens signs on the bottom line on their valuations. It's defended by us. We have to have the best data, and we have to be comfortable with what's going on in the business. And so we ask for a lot of data to ensure that.
Yeah, helpful. And just kind of made me think, I'm assuming that your specialist, whether it's a calculation of value or a full-fledged appraisal for maybe 706 estate tax return purposes, I'm assuming your people will get on the phone, get on a webinar, a Zoom with the FinPro, the client, and their other advisors, and go through it. Not everybody is a valuation specialist. You guys are, and that's just not a second language for a lot of people. I'm assuming that's a service you guys also provide.
With our calculations of value, we come back with our exhibits and we talk it through with the advisor to make sure they understand it. From our perspective, the advisor is our client as well as their clients are our clients. They brought us a company that's important to them, and we need to make sure we explain it to them and understand how we arrive at the results we do. Sometimes the results are spot on to what the expectations are. Sometimes expectations of value differ, whether it's positive or negative. But it's important for us to explain how we arrive at it and what the numbers look like. And we will do that for the financial advisor, and then we'll do that for the client if that's what the advisor would like us to do. We'll explain the results. And that goes for our formal valuation for sure. I mean, we come up with numbers and at the end of the day, and there's a whole conversation and back and forth during the process because we're always asking questions. We're asking questions, we're trying to get more data. We're looking for some nuance in a revenue stream or something. And there's always communication between us and between our senior appraisers and the clients to get that. And then at the end, we'll present, talk through, however you describe it, what the final numbers are in any valuation.
Yeah, very helpful. Another thought question. Without either of us getting too nerdy here, it seems like there's this dichotomy, if you will, between valuing a business appropriately, using the appropriate financials. And there's a value for purposes of selling it maybe to a third party. But the fact of the matter is there's a lot of businesses that are family owned. And
Yeah.
maybe it's a senior family member trying to transfer a business interest to a junior family member, maybe a son or a daughter. And we hear things like, applying discounts for lack of control and lack of marketability. So can you clear the air there? What are we looking at? Is it possible to have effectively two different valuations depending on whether it's a family or not? Help us out here.
Big question. A lot of different ways to answer that. And let's talk at the top level first, and that is, what is a transaction? Everybody seems to think, okay, a transaction is when I'm selling my business. No, not necessarily. Transaction is in quotes, it's a big term. A transaction, yes, could be the full sale of a business to a third party, to a private equity firm, to a competitor, a strategic buyer, however you would describe it. And that may look, in that case, you may be looking to achieve maximum value, the highest valuation possible. On the other end of the spectrum is a transaction that may be involved gifting or transfer to a family member. And obviously the lowest value is gifting when you're not getting anything. But then you may say, hey, look, I want my kids to buy the business. I'm going to gift them part of it, but I need some money, or I want them to at least have some skin in the game. And so you do a discounted value. And maybe there's an ESOP in the middle, and you're doing it at fair market value, because fair market value is the valuation standard that the Department of Labor uses for ESOPs. There's a whole range of different types of transactions. I should add, there's management buyouts. There are different types of transfers. There are about 8 or 9. We have a whole chart of different types of transactions. What they all have in common: the highest value is to a strategic buyer. The lowest value is transfer to a family member, gifting, and there are a bunch of different ways in between. So, having said that, you try to do a valuation that's appropriate for the circumstance. Obviously, in the case of a strategic value, you're looking to value it. You're looking to show the positives, everything that's going on, and you're creating a presentation, an argument, a demonstration that you should pay a premium. You should pay a higher value for this business, a premium to fair market value or fair value. That you're trying to justify that. On the other hand, when you get to family, it may be estate and gift. In that case, you've got discounting that applies. Discount for lack of marketability, for people who don't know, is when you're a privately held business according to fair market value theory. A discount from lack of marketability is applied because you are a privately held business. Only publicly held companies are considered fully marketable. Privately held businesses are not, because it takes time, it takes effort, it takes money to get your money out. Therefore, you deserve a discount for lack of marketability. On top of that, if you are doing a minority transaction, and a minority transaction is a transaction that is less than 50% of the stock of the company. So 50% minus one share all the way down to one single share requires, or deserves, a discount for control, or a minority discount, depending on the terminology. For gift and estate, if you've done estate tax type of valuations, that people apply discounts for minority positions to lower the value. The same thing applies for gift and estate. If for gifting valuations, if you are doing it, maybe you're selling a minority stake to a management team member, maybe your discount's a little less. You're not looking to maximize the discount a little more. There's a lot of nuance along the discounting and along the valuation. It's key to identify what the purpose of the valuation is, and apply the best methodology and the best discounting, if appropriate, to that circumstance.
Here's a loaded question. I know people have to be thinking this right now. How does the IRS view some of these valuation discounts, especially amongst family members? Presumably, if a discount is too steep or not defendable, that's going to get their interest. What's at stake? What's at stake is taxes. That's their interest, is making sure they rake in the appropriate amount of taxes based upon it, but they consider it to be a fair valuation. But can you hit on that?
You said the operative term, and that's defendability. And the key is that the valuation needs to be defendable. And Marshall and Stevens, when we issue a valuation opinion, it's signed by Marshall and Stevens and it's defendable by us. So that's why we are always looking for the best data we can get. And we go through an extensive process and review process of the valuation at the end to make sure we can justify what we've done. Now, everybody's looking for maximum. And, again, it goes into assumptions. It goes into the circumstance. It goes into the industry or the purpose or the dating. There's a lot of different variables. I mean, I'll throw out just in our gift and estate, we have a really fabulous gift and estate team, and they've written a bunch of articles on valuing family. They've actually written the textbook, I think, on valuing family limited partnerships. And, these things vary. And, we work with the client, we work with counsel, we work with who's ever appropriate to come up with the best defendable value. And in some circumstances, you can be more aggressive than others. Again, it all depends on what's going on in the data and the need. But we spend a lot of time making sure that at the end of the day, when we Marshall and Stevens issues a report, we can defend it, we're comfortable with it, and it meets the needs of the customer from a reporting perspective and from a planning or execution perspective.
Yeah, and just kind of makes me think of something else. A lot of times a business represents a business owner's retirement plan. It represents, in some cases, their estate plans. You could have a business and a estate and retirement plan all wrapped into one thing, especially if the business comprises the majority of somebody's overall net worth. How do you approach that dynamic when you're working with financial advisors and clients?
I mean, it's funny, we joke sometimes this turns into counseling sessions because, the business owner, every business owner is different. A business owner may say, hey, look, I'm going to die at my desk, and there's nothing you can do about that. They're going to work, they love their business, they don't have anything else, and they're just going to keep on working. That's one thing. On the other hand, there's a lot of people out there know they want to retire, and they think they have a time frame that they want to hit, but they really haven't put any plans behind that process. First, again, it's important to understand what the objective of the client is. What do they want at the end of the day? Do they want to retire in a year? Do they want to retire in 3 years or 5 years? At that point, once you understand that, you can help develop a plan. But really, in order to develop that plan, you need to know what the value of the largest asset is. So we start with that calculation of value simply to figure out what the general valuation is. And again, it's a ballpark. There's no transaction here. We're just trying to figure that out. And by figuring out that a business is worth $10 million, making up a number here. Okay, we can talk. The advisor now has a number to begin an estate tax conversation. What other assets do they have? Now do they have more assets than the combined exemption? I don't know, but the advisor might, or the estate attorney that's working with them. And then the question is, okay, how do I get rid of my largest asset? Do I want to get rid of my largest asset? Do I want to do I want to gift it to my kids? Do I want it to sell it to my managers? Do I want it to sell it to a third party and maximize my value and go off and go to the beach? And in how long do I want to take to do that? You've got to understand there's a bunch of questions here, but the first is you understand what the value is, then you help figure out a plan, and that plan includes the time frame, and you help do your planning. And the planning may be life insurance. It may be, some sort of gifts and estate trusts and stuff like that. There are a variety of plans that you go into it. And then maybe there is a sale or transfer of the business down the road. If there's a sale, and we do a lot of sell-side M&A work, we then look at it and say, okay, what's the market for the business? Is there activity in the marketplace? What is a legitimate value here? Are there going to be buyers? How fast can we actually get a transaction done? Is the company ready for sale? Do we need to do some prep work? Are financials in good shape? What does the accounting look like? There's a whole process here, and we do it all. And, you can do it in 6 months, you can do it in 18 months, or maybe it takes longer, or maybe the vision is longer. There's a lot that goes into that. But the thing is, we like to take a step back, do a holistic approach, work with the advisor, work with any professionals they have, and come up with a value. And then if appropriate, we'll help participate in coming up with a plan of action.
It always inspired me to ask other questions,
Go
Steve.
for it.
So
Absolutely.
got another one here. So, you and I were just discussing how a business can represent both a business estate and a retirement plan. You've dealt with thousands of business owners. Is there one or two things they underestimate or miss, these business owners, that maybe the business is their retirement plans, or something that they miss when they transfer the business, that you just like people to know about? They're listening here.
Well, as a first step, let me just step back and say one of the most interesting conversations we have when we do a calculation of value and we get 3 years of financials. Sometimes people will give us 4 or 5, which is great. We love it. I should say 3 years is the minimum. If you want to give us 5, hey, that's fabulous. We'll spread them out so you can see them. And that's the interesting thing. A business owner may not necessarily have seen the last 5 years or 3 years of his financials laid out year after year, and he can look at his revenue trend. He can look at his expense trend. He can look at his earnings trend. That data, that 5-year performance, that 3-year performance is in many cases new and novel to the business owner. They always see the year before his performance. They say, okay, I got to do better than last year. This is what I got to change. And they're looking at the next year. And then they're looking at kind of longer term trends, and that's important. And in order to maximize your value in any transaction that you do, if that's your objective, the key is to sell into any trend. It likes to be a positive trend. So if your revenues are increasing, if your EBITDA is increasing, that's a great trend to sell into. And that's going to get you a higher multiple, a higher value. Things to keep in mind. From a business owner's perspective, it's also important to understand what you're actually running through the business, and understand how that is an adjustment to earnings. There's nothing wrong with doing that, and many companies do it, and that's fine. But you just need to understand that if you do have a company truck, and you can add that back, because that's not an expense that's necessarily going to be necessary for in a perfect world. And you try to get EBITDA in utopia, a perfect world where all the expenses are perfect. Maybe there's the club membership, or maybe there's some travel, or whatever it is. That adjusted EBITDA number is really important. And by figuring that out, number one, you're increasing earnings, most likely, by accurately showing what your performance is. Number two, you need to understand that when you sell or transfer the business, you may no longer get those benefits. So the question becomes, if I sell my business for $5 or $6 million, and once I pay my taxes, are the proceeds from that transaction enough that I can live my life as I've become accustomed to? Or do I hold on to the business and let somebody run it for me, and I just simply show up 3 days a week and go fishing twice a week?
Yeah.
Those are questions that you need to think about, and they're big picture questions. And the last one I'd say is, what are you going to do when you're done? 6 months out, you don't want to have regret as to what you're doing. You have to actually have a plan.
Yeah. And all those things, and the impact of income taxes upon a transfer.
100%.
I think all those things are relevant, right?
It's the big picture. It's, what's your cost basis? What's your proceeds? Realizing you're going to pay 25 or 30%, depending on where you live, in tax if you have a zero cost basis, which many businesses do. It's all part of the mix, and you have to figure that out.
Yeah. Two things. I mean, you and I predicted this was going to go pretty quick here, and
Yep.
it has. Conley has come up in the chat. I was going to ask you about it. So let's wait until the very end, because there's a couple of listeners that want to understand the impact of Conley on business valuations. We're going to hold off on that Conley for now.
Yep.
And I also need to read the next CPE participation code. So CPE participation code number 2 is NAIFA. That's NAIFA. So CPE participation code number 2 is NAIFA, NAIFA. All right. So let's move here. because we really only have a few more minutes left before I'd really like to get to some of this Q&A, Steve.
Sure.
So I'm thinking about the financial professionals that by and large are listening to you and I talk here today. Because I know what's going through their mind is their own practices and their own ideas of what valuation is and what they can get out of their financial practices. I know this has been a particular area of specialty for Marshall and Stevens over the last couple of years, and it's very close to home. Are there different factors or considerations that financial professionals, advisors, agents have to be prepared for when they consider transferring their own practice?
There are a bunch of different things to keep in mind. First, you need to understand what the value of the business is. But in order to do that, you need a really good breakdown. More buyers these days are looking at differentiating revenue streams. And I said this before, buyers will put different multiples on different revenue streams or different ways the business is earning revenue. Asset management is different than annuities, which is different than whole life, which is different than term life, which is different than everything else. There is, and the multiples can be significant. It really can. The difference in multiples can be significant, I should say. A lot of people out there are looking for assets right now. If you're a firm that has a lot of assets as part of your service, you're getting a big multiple for some of those assets. Sometimes some crazy multiples I've seen out there. That's important to keep in mind. The other thing is really the transition. We haven't talked about this overall, but as part of any transaction, there is a transition after the transaction, where in some cases the owner, the FA, whoever you want to describe, is still part of the business or has to stay part of the business in order to collect out all the proceeds that they may be promised. There's an earn-out there. It's frequently in place in some of the financial advisor transactions. People don't want you to just kind of sell and disappear, and the relationships go with you. So there's got to be the realization that yes, I may sell, but the odds are I'm going to be sticking around in my business for a couple of years. The other thing is that in some cases you're being asked to buy in and actually become part of the team. You're selling your practice and becoming part of the larger team, and actually maybe a stockholder in the entity that's buying you. And so you need to think about what the value is to that, and frankly, what the fine print is as to how you get your money out at the end of the day, because sometimes it's a long time before you actually get liquidity for that. And keep in mind the markets can vary, and they can get picky. And industry, there's industry rotation, and everybody knows that term, where some industries get more popular than others. And over time, all of a sudden, an investor who has aggregated a bunch of a particular business, financial advisors, whatever, who thought that he was going to go out and sell for a larger multiple or do a public offering, may have to wait a little longer because the market turns or the market's not optimum for doing that. So you need to think about how much money you're getting initially and how much money you may be getting subsequent in any earn-out or as part of a participation. There are a lot of different things to keep in mind there.
Yeah, I'll say that's quite a bit to think about. And I know as we come close to opening up the Q&A, I would really love for you to talk about maybe 3 takeaways. But before we even get to that, maybe within a minute and a half, if possible, let's make this real. I believe there's a big case that you've worked on. You and I have discussed a lot of different cases in the past where estate and business planning kind of intermixed with one another. Give me some background of the case really quick, and what was the role of Marshall and Stevens?
There was a case, and then you and I worked on this one together. It was a manufacturer of a consumer product, and he was older. I mean, if I'm not mistaken, he was in his late 70s, maybe, when this all started, and there was little to no organized estate plan. The business developed a product that got in huge demand. And as a result, revenues and earnings went through the roof. A large retailer began selling the product. It got a lot of interest and a lot of demand. And as a result, the company did really well. So instead of having a small, sleepy little company with a small valuation, we now have a much larger company with a much bigger valuation that blew through that appeared to blow through a lot of the estate and gift exemptions. So we were brought in to take a look at the financials and see if we could assign a value here. We actually did a calculation of value because we didn't need to do a full formal here, but we did a calculation of value and came up with a value. Again, this turned out to be somewhere in the $50-55 million range, if I remember correctly, as an overall value. And we were able to get our hands around it and provide your team with a good value that you could then do the planning on. And if I'm not mistaken, underwriting then took a look at it, was able to use some of our financial work to understand the process, understand how we arrived at it, and got comfort in order for some life insurance to be sold to help mitigate some of the estate tax liability that might have been there. It was a wonderful example of how everything worked very well together, integrated. There was a great company who did well. There was a client who had a specific need. We were able to help on the valuation side to quantify the value of the asset, and then you guys were able to take the information we had and and help with the planning and execution side.
Yeah, no, that's kind of a case in real time was good. I know you partner with financial professionals and carriers all the time, and that was an excellent. You mentioned underwriting. Getting underwriting on board is huge. Making sure they work with your firm, Marshall and Stevens, and they're comfortable with the valuation from a life insurance perspective, because often you're going to need the life insurance for estate liquidity or buy-sell purposes. So that's huge. Okay, we're going to talk about the Q&A. Some really great questions. I really want to get to these. 3 takeaways as we kind of wrap up the formal part of our interaction here today. What would they be, Steve?
One is that it's really important to understand the value of the client's largest asset. The client being your business owner, whatever, but also you, the financial advisor. What is the value of your asset? What is the value of your client's business? What is the value of the client's, farm? Whatever it is, in order to make a good plan, a good estate plan. An estate plan includes a business succession plan, a personal plan, and all that. It's all encompassing. In order to do that, you got to understand the value of its largest asset. And it's not that difficult through a calculation of value to figure out the value of the largest asset there. There are ways to do that. It's relatively simple, and it can be done, and that way you can do an educated plan. That's really that should be a huge takeaway. Another takeaway is it's really important to have good financial data. I think we see a lot of different clients who have they're still doing their financials on their QuickBooks on the kitchen table. As you get to be a larger business, as you get to have revenues of $4 or $5 million and more, you need to be able to report your financial data clearly and be able to discuss it, because that's failure to be able to tell you to have good, accurate data is going to affect the value. It's going to affect whatever transition you do. It makes a huge difference. And finally, I would just say, for everybody out there, valuation is important, but it's not scary. We're not scary people. We're out there. We're independent. We don't get any kickbacks or any commissions or anything on any of these. We're here to do the valuation, or if there's a sale assignment or something, that's our job. And we're going to be independent, and we're going to ask sometimes tough questions, sometimes questions that are unexpected. Sometimes we'll laugh about questions, but it shouldn't be. It's not an adversarial process. We are here to do the best job we can to develop the best valuation possible for your objectives. And I think, just don't be scared by the whole concept of evaluation.
Yeah, really helpful. Before we get to some of the questions that are being put into chat, we're going to have our third CPE, third and final participation code. So the third and final CPE participation code is the following. This is number 3, 0722. So the code is 0722. Again, 0722. That's the third participation code for CPE. Let's go ahead and get to some of these questions. I've been holding off on Conley here, Steve. So, what are some of the inaccurate assumptions people have made about the Conley case, business valuation, and Section 2703?
I think this is my personal opinion, my fundamental opinion is that, keep in mind, Connolly was a 9-0 opinion. All right, Supreme Court, all 9 of them agreed on this one. So this comes down from Mount Olympus in their opinion here. The fact is that I think the message to everybody is, if you just look at what the law says and the regulations say and follow it, you're fine. I think in the Connolly case, people, maybe lazy is the wrong term, but people put the insurance in the business. If it's in the business, it's in the business, and it has a value, and it's going to raise the value of the company. And, any proceeds that you get are going to come into the company. You can't put it in the business and assume, oh yeah, if it's just sitting there, we're going to use that to buy the stock of the company and give it to somebody outside. It's pretty clear that there are other rules out there that says that that's not best practices.
Was it one of the deals with Conley is because it was what they call an entity redemption agreement, with the business being like the owner and beneficiary, that the proceeds that came in were additive for federal state tax purposes. They were additive for redemption purposes. Previously, I think most advisors had looked upon it as being like transitory. The proceeds would come in and then go right back out the redemption. But the Supreme Court in Conley said no, these are actually going to be additive.
Right, because the cash went on the balance sheet, technically.
Really?
Really want to argue it. The cash went onto the balance sheet. And when you do a valuation, and again, I use fair market value because fair market value is really an important standard here. You look at it, and adding cash that's on the balance sheet back is key. It's a key component. Just like taking debt out. You add cash, you subtract debt. If you added $1 million in cash on the balance sheet, your valuation is going to increase by $1 million. I think the key here from the court's view is that if it's on the balance sheet, it's going to increase value, and that's always been the case when you look at it from a valuation perspective.
Right. Thanks, Steve. There's lots of questions that come up. I'm not going to be able to get to all of them, so I'm going to have to pick and choose just a little bit here. Another question for you, Steve, is what business and tax certification do you recommend for an advisor to obtain? I'm assuming they mean for themselves as opposed maybe to a client. How would you answer that?
For a financial advisor, is that what you're?
It just says for an advisor, so I'm assuming it's financial advisor.
I mean, look, there are a lot of great a lot of great certifications out there. I mean, CFP is great. Right now the hot one is SEPA that's out there. A lot of the organizations, insurance organizations, a lot of them have good, solid accreditation processes that are out there. From a you don't need this. This is more of from a transaction or an analyst perspective. CFA is a very tough test. If you pass the CFA, there's a lot of, I give a lot of credence to people that are CFAs and CFPs. That's, those two are really preeminent in my book.
Thanks, Steve. Another question here. With so many ways to value businesses, is it possible to give us some ideas of cost of valuations at different levels, generalizations? 50 or 20,000? What kinds of things can our clients expect? So I know I've talked about calculations of value, which you do with various carriers like Midland National on my own.
Yep.
But sometimes you got to take extra steps, maybe to peg it for estate tax purposes or other reasons. Can you give us some ideas of what the cost of those might be?
To do a good old fashioned fair market value valuation. This is a middle of the road valuation of a business that you just in general, that I again, don't anybody hold me to these exact numbers without knowing specifics of a circumstance. But if we're a run-of-the-mill company with decent financials, without a lot of questions and everything, we'll charge, 16 or 17,000, $18,000 for a formal evaluation. On top of that, then if you are doing this for gift and estate purposes, frequently you have to do what's called a discount study. A discount study is a in-depth study, a way of defending the discounts that you use to bring the value down. And a formal valuation plus a discount study is what you submit to the IRS when you're doing gift and estate reporting and everything. And that's probably another, $3,500. So if you're looking at a full formal valuation for gift and estate for gift and estate purposes, I will say it is going to be between, for a run-of-the-mill company, don't hold it to me, between $16,000 and $20,000 for a simple project, and then it goes up from there. I mean, if you have multiple entities, if you have different assets that need to be valued, maybe there's real estate that needs to be valued. Maybe there's farmland or there's businesses. I mean, you look at a farm, there are actually multiple ways to value a farm. There's the land, there's the assets, and there's the going concern business of itself. In theory, you've got 3 different valuations there. I mean, it all depends on the circumstance. I know that's vague. It's tough without knowing exact, circumstance how to apply
No, I get it. I know we just have got down to 2 minutes left, so I'm going to read a comment, which I think is interesting, and then I'm going to give you one last question. Fair?
Yep.
Okay. Comment. This is from Rich Coffin. I just liked it, so I'm going to read it. It says, valuation is the key to all business planning. Need to have a starting point, and most business owners have no idea of the value in the first place. Right?
100%. I mean, they have some kind of sort of idea, maybe, where they've talked to their buddies or something like that, but they don't really know based on their own circumstance what their business is worth.
Beautiful. Okay, maybe one more minute before we turn it back over to our friend Shannon. This is the last question.
Yep.
How often does the IRS order a business valuation when a high net worth business owner dies? Let's just hit that first part of that. I presume, if they have vested interest, they don't see a valuation that's defensible. Does the IRS get involved in the business of ordering valuations? How does that work?
Yes, the IRS will order a valuation, and they'll hire somebody like us to go in and value the business. If really best practices, and again, it's not the right term, but I'm going to say a valuation is almost an insurance policy. If you do a good valuation and you're doing it for estate purpose, if you have an asset that's significant or an estate that's significant, the chances are of it being questioned or examined is much greater. The cost of doing a valuation as part of your reporting process versus having the IRS order it is much less. I mean, the IRS, and keep in mind, when the IRS orders it, they will basically say they will hire the group they want, and they will send you the bill. You're paying for it one way or another. You're paying for it, and when you're doing it as part of your process, you maybe get a little more favorable, issues and questions than you may on the other side. The IRS has the guys that do it on the gift and estate side and the higher end side are extremely professional, and they're extremely knowledgeable. They're not your run of the mill, person or cartoon type of thing that you see. They know what they're doing.
Well, that's helpful. Yeah, I know we're kind of getting right to the top of the hour now. No, that's good. So if people want to get a hold of you, if they want to know more, I'm going to put the way to get a hold of you. Hopefully this is okay, Steve. Right into chat. Does that look accurate?
That looks accurate.
Okay, beautiful. Steve, thanks for your time and attention. Thanks for the
Thank you.
conversation. That was a heck of a lot more entertaining than a PowerPoint presentation.
My pleasure, Andrew, and I appreciate NAIFA setting this up. And again, I appreciate our friendship.
Absolutely. Thank you, Steve. Thank you, everyone. Let's turn it back over to Shannon for some last remarks.
Yep, just a couple of closing comments. Thanks, Steve and Andrew. When you exit the webinar, you'll be directed to an evaluation. If you could take a moment to complete that, we always appreciate the feedback. And a reminder for those that need accounting credit that you will need to enter the 3 CPE participation codes that Andrew announced during the webinar. They go on the last question of the evaluation. And on behalf of NAIFA, I'd like to extend our appreciation to both Steve and Andrew for the information and insights you shared with us today. And a thank you to our iREP Center sponsors. Thank you all for your registration and participation. And with that, the conference is adjourned. Thank you. Have a
Thank
great
you.
day. Thank you.
Thank you.